Good day, traders. This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 30th. Some highlights from today's show. India is the first country to get a tariff deal. Oil and shipping is now signaling a recession. And US GDP Advance is in focus. A happy Wednesday to you all and welcome. We are at the midpoint of the week and also at the starting point of what is going to be a very volatile finish over the coming 3 days. There's a number of things going on. I mean, we've got month end today. That's the first hurdle to clear. We, of course, also have got a US GDP Advance, which we'll talk about a little bit later on. And then, of course, we've got some key earnings today, not tomorrow. That was a bit of an error. The earnings are coming from, of course, the likes of Microsoft and Meta. And like we spoke about the CapEx spend yesterday, that's going to be in very much in key focus, of course, later on after the close today. And then, of course, we start to move into tomorrow and Friday with the key data, of course, being the headline non-farm payrolls, which is just going to end off what is going to be likely a very volatile coming 3 sessions. Now, with that in mind, let's get across and talk about some of the key things to focus on. And it's very much come across from the headlines yesterday from Lutnick. He's come out, he's told us there is a deal has been struck. He cannot tell us who the country is because they need to wait for the Prime Minister, and I think that was a little bit of a clue, talking about a Prime Minister as well as a Parliament that needs to approve it. And so the speculation is rife. Of course, Trump came out later and said things are going very well with India. So the speculation is rife that it is India. Now, that matters for a number of reasons. India is not a small trade partner, but more importantly, whatever India gets in terms of treatment, whatever the outcomes are for India, the market is going to run with that playbook and they are going to apply that playbook to everyone else. Okay? And that's the key thing to stress. Look, if it was one of the smaller countries, if it was Singapore or the island with penguins on, I'd say fine, ignore it, it doesn't matter because those sorts of deals are relatively small in nature. But it is India, and what we can see from our table, and this is a great table to actually print off and keep it on your desk, what you can see is India is, of course, around 2.7% of the US total imports. And of course, they did get a 26% reciprocal tariff applied. So then what the market's going to do is they're going to say, okay, well, look, if the Indians can come to a meeting and they can agree to get that 26% down to the 10% like everyone else has got, that is actually not such a bad case. And the market will then sort of think 3 steps ahead and say, well, if India can get it, so can Japan, so can the EU, and eventually so can China. Okay, and that's the general way the market's going to think about this. Success with India will mean success with everyone, and that effective rate then starts to move a lot closer towards that 10%. Now, sure, there are individual country negotiations that need to take place, and this sort of idea, this assumption that everyone will get 10% is very far-fetched. I get that. But unfortunately, markets don't think that way. Markets think with very much a positive tone, and the markets will think, well, look, if they can get it, then so can everyone else. Therefore, the initial move will be taken very positively. Okay, now, like I said, devil's in the detail. Does India get it all the way down to 10%? The speculation is rife that that is the case, and we can see that just looking at the chart. Okay, this is the Indian rupee as of today. You can see it did absolutely nothing for the last 6 sessions, and suddenly we are up just shy or almost 1% on the day against the dollar. More importantly, you can see we are now below that Liberation Day level, so the Indian rupee is strengthening quite aggressively on this speculation that it is in fact India that's going to get that deal. Now, some of the key things to take away is, and just to stress, is that in the near term, in the sort of the absolute, when this announcement does come out, the market will run on it. It'll like this idea that India can get it down to 10%, therefore so can everyone else. But in reality, remember, it's all about the big 3. Okay, it's all about China, the EU, and Japan. At the end of the day, and we can throw South Korea into that because we got an update from them last week. Now, from these 4 countries, we can see the same sort of playbook. They're all sort of having this idea of extended negotiations. We'll exclude China for now because they've said that, refuse to negotiate until the US removes all tariffs. But what we can see from the EU, Japan, and South Korea is things are not going as sort of quickly as touted by the US. Things are not moving along very positively. Okay, the EU has US said they don't actually even understand what the US's stance is right now. Now, there's a key thing to take away from this article, and what it was that whilst the deal may be on the table, the key thing to stress is there is talk that it could take up to 6 months for the Indian Parliament to actually approve the changes to the tariff line code. Okay. Now, why does that matter? Well, because don't forget, we've only got a 90-day extension, which is now somewhere closer to around 75 days. Okay, the point is that we are running the clock down, and like I said, the longer the uncertainty remains, the more likely a recession comes. Okay, so I just want to stress that if India is going to take up to 6 months, what about nations like the EU? What about Japan, South Korea, and some of the other bigger nations? Moreover, what about China? Okay, we're not even at the point where China wants to talk to the US yet. And so again, the key thing to stress in all of this is that fine, there may be a deal on the table. Okay, but the longer this whole episode goes on, the more likely a recession grows. And of course, at some point, we are going to see that opportunity scope in the markets. Okay. Now, let's move on and talk about some freightening stuff. What a lovely use of a pun from the likes of The Economist. Always good to read The Economist, and they've kind of put out this chart just looking at freight prices in essence. And the key takeaway is they're down around 30%. Okay, so freight prices have dropped around 30% since Liberation Day, and the reality of that is, fine, we're not quite at those March levels yet. So we did see that expense pick up quite aggressively because everyone was importing quite aggressively ahead of that tariff deadline. We're now back to sort of call it pre-Liberation Day levels. But what's going to be key to watch here now is if these freight costs continue to drop. Why? Well, at the end of the day, freight pricing works as a leading indicator. Okay, if you want to get ships out on the water today, you are going to try and discount the price today for goods arriving in the US or wherever it is around the world in a couple of weeks' time. Okay, keep in mind it takes somewhere between 15 to sort of 40 days for freight to move from China to the likes of US. So this is very much a leading indicator, and this is kind of what the Economist is leaning on, which is this idea of freight prices are dropping off quite aggressively. That in its own is not a recessionary signal, but it's the speed at which they're dropping, suggesting that discounts are being offered in order to get freight on the water. If we then go across and look at a fantastic chart from the market here, they're talking all about S&P 500 earnings revisions. And again, this is something that's watched very closely by a lot of fund managers. They do lean on this in terms of positioning. So we can see there again, earnings revisions are coming in thick and fast. We, of course, are in the heat or the middle of Q1's earnings, and they're just being revised down very, very aggressively. Now, fine, we are just returning back to those sort of 2022 levels. Keep in mind that was the last time we did have an equity market correction, but the speed at which this is moving does suggest there's something more aggressive in the market, which is some form of a real-time recessionary indicator. Okay, and then there is the article from The Economist. You can go and read that, take a snapshot of it. I think the key sort of takeaway, what they're talking about here is, what is the impact going to be of these tariffs on US GDP? We, of course, do have that advanced data print today. And the key general thinking is that because there was quite a lot of front loading ahead of the tariff announcements, that we are going to see quite a significant miss or a negative print today on the GDP. But in reality, a lot of that is due to the volatile nature of these imports being front-loaded. Now, again, we'll talk a little bit about that data point in a minute and how to trade it and what to be aware of. But the reality is that this GDP print is going to be a difficult one to trade, because on the one level, yes, a negative print is still a negative print. It doesn't matter how you want to sort of wrap it up and tell us it's because of front-loading. The reality is they're front-loading those goods, and any future goods are going to come in at a much higher price. So the logic is that, well, fine, you front-loaded it. Once that stock is depleted at whatever price, you are now still sitting in a situation where there is just a very, very big demand shock coming in. And I think that's going to be the key takeaway from this GDP, which unfortunately we're only going to find out about when we get the Q2 GDP in about 3 months' time. Now, with that in mind, again, I'm showing you a number of charts here because I'm trying to build a picture of how the markets are interpreting this tariff situation. And what we can see as the rates markets, the US rates markets, with our vertical line being effectively Liberation Day. And the key thing to stress from this is if we look at sort of the front months, so we go and look at where rates are today, sort of expected to be in June, September, and then December, we can see that there's no real initial rate cuts being priced. Okay, if anything, you can see Liberation Day there was a little bit of rate cuts being priced for an immediate move from the Fed, that's been washed out. Okay, we can see if we go a little bit further out, zoom a little bit further out, the market's thinking around 50 basis points cuts coming by September, so 2 rate cuts, and then almost call it 3.5, 4 rate cuts by the end of the year. Okay, so right now the market is pricing in quite an aggressive Fed. Don't forget, as per the dot plot, that we got in March, the Fed told us, nope, we're only going to cut twice this year, twice next year, and one final time in 2027. The reality is Powell came out just a week and a half, 2 weeks ago, telling us that there's no imminent rate cuts coming. They have to understand the nature of inflation before they can start moving. So you would think that 2 cuts priced by December is perhaps not a tall order, given a lot can happen between now and then. So yeah, I think the pricing is pretty fair. If we then go a little bit further out all the way to December next year, we can see around 140 basis points a cut. So market thinking 6 rate cuts between now and the end of next year. Fed thinking 4 cuts. Again, I don't think the market's pricing is necessarily wrong, because they are, of course, pricing a recession in real time. And then finally, one of our key sort of recession indicators, and this is the market to pay very close attention to. It's a very pure market in a sense that it does give us a good lead on ultimately just economic global growth. Okay. Now, what you can see as the oil price, and we'll actually get across to another chart in a minute, but I just want to talk about oil in general in terms of trend, because what we saw for pretty much the last 2 years, if we look at this purple line, is a flat WTI oil inventory 200-day moving average. Okay, in other words, oil went nowhere for 2 years. It was stuck very much around $75 a barrel. Okay, then all of a sudden this year something happened, and again we've put that Liberation Day line in because it does seem as though the markets have created some fundamental shifts since that day. And in reality, what we can see since Liberation Day is that oil's now broken that trend or that range between 66 and 86 that we were stuck in for 2 years. We've accelerated below it initially as those tariffs came in. We tried to bounce, but we're now making new lows. And I think that matters a great deal because S&P is still staging a very decent bounce. A number of markets are still, sort of staging or retracing almost all of the moves seen since Liberation Day, but not the oil market. Okay, and this is why it's a pure macro indicator, because it's telling us everything we need to know about demand destruction for oil. Okay, that's what's going on. Now, yes, some people are arguing it's because OPEC is increasing supply. I think that's rubbish. I think this has got a lot to do with just the fact that a lot of people are looking at it saying, well, if we are going to see a softening in growth around the world, the reality is there's not going to be that much demand for whatever supply of oil you've got coming down the pipeline. So I think that's the real key takeaway, as oil is signaling that recession. It is showing that weakness, and it's going to continue to show that weakness over the course of the coming days and weeks. And if that's the case, you don't want to be bucking this trend of a global growth slowdown. I think that is the consensus play now, and so long as oil keeps trending down, that is confirming very much that we are in an economic slowdown and perhaps even a recession. Now, one thing to watch out for very closely, and we saw something like this in 2020, and I think if you were trading 2020, I'll cast your mind back. It's when oil went negative. Yes, futures prices traded negative. And what happened ultimately was there was this very aggressive shift into contango, where there was just so much supply of oil in the near term that because everything shut down, there was just so much supply of oil that spot prices completely collapsed down the page, and so we just had this massive contango. So go and have a look at that, and what you would see ultimately on a chart, you would see effectively it spikes above zero. Okay, this chart at the bottom is just a spread between spot and 3 months out, and so ultimately what we had was just a massive spread widening between oil prices today versus a couple of months out, and so the result of that very aggressive blowout in the spread indicated that there was a fundamental problem in the market. Okay, and so that's what we're looking for. We're looking for this very quick aggressive steepening above that zero line, because what that's telling us is there's just so much supply of oil in the near term now, and that is telling us something bigger, which is we're actually in a recession already. Okay, so this will be a very good leading indicator as to recession. If you're confused about whether or not we are in a recession, you're going to read a lot about we aren't, blah, 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 blah. The reality is, if we go into contango, it's because there's just so much supply in the near term. Okay, now fine. What I did try and do was go and have a look at in terms of the oil, go and have a look at the impact because of OPEC supplying more oil. And fine, we can argue that them supplying more oil is going to lead to a little bit of softening in prices. But what I want to stress is if we go back and we look at the start point of when the OPEC started those involuntary cuts, it was all around the Q1 2023, and we can see that that sort of restriction of oil supply didn't really have a significant impact in terms of the trend of oil. Okay, we effectively went sideways for 2 years. Now they've started to sort of bring back some of that supply, but again, that only adds to this downside pressure in the price of oil. Okay, so keep a very close eye, because that is going to be a fantastic indicator. And then finally, let's turn our attention, of course, to the key data point for today. It's all about US GDP Advance. And again, I want to stress that there is a number of things that can happen yet today. The general thinking from two banks, Goldman Sachs is talking about a negative print. We got Morgan Stanley talking about a negative print of 1.5% annualized. Okay, now yes, that is going to alarm a few people in a number of different ways. But I think the key thing Morgan Stanley was trying to stress, and I think this is key to take away from it, is if you go and work out the GDP and remove the imports and exports from the situation. Okay, so if you think of GDP, it's C plus I plus G plus X minus Z. Effective, if you remove that last component of trade, which is naturally quite volatile, they think that GDP would come in around 2.6%. Okay, so the point being is that when you remove the volatile aspect from it, call it like a core GDP almost, the result is that we do get a very positive GDP print for Q1. Okay, so I just want to stress that this number today is going to be heavily influenced by whatever happened in terms of the imports coming ahead or front loading of the Liberation Day. So take everything with a pinch of salt. Now, it's not to say, and this is the tough thing about being a trader, it's not to say the markets might overreact to it. They could. Okay, the markets could very much panic on whatever the number is, and then maybe some sense of stability comes back into the markets today. We just don't know. Okay, but the point is at a trade level, this is one of those things where us as day traders haven't necessarily got much of an edge. Okay, because what do we trade off of? Right, at the end of the day, we don't have economic models that can look deep into each component to really understand in depth as to what we actually are seeing on our screen. So it's just one of the things I warn against. Be very careful, particularly for today's GDP print. A number of things can happen. I suspect the markets will be very thin, and it is one of those things I suspect you rather want to let the dust settle a little bit, because I think there'll be far easier opportunities to trade over the course of the next coming sessions. Okay, with that in mind, then of course, like I said, it's very much about the GDP for today. That is going to be the headline focus, and then of course we'll move on to the month end rebalancing, where there's quite a bit of work to do, particularly in the dollar space, so pay attention to that 4 p.m. London fix, and then finally we have got the earnings later on tonight. With that in mind, if there are any other questions, do post them in the Discord channel. Otherwise, good luck out there today. Go manage the risk, go make some money.